We are diving deep today into, well, the complexity and a bit of the chaos surrounding the Q3 2025 results for DeFi Technologies. That's ticker DEMT.
It's a fascinating one. If you're tracking this space, you know this company is trying to be this integrated crypto finance platform.
Right, and they're walking a very, very thin tightrope.
That tightrope is the whole story. On one side, you've got this, reliable, almost predictable growth from their asset management business.
And on the other,
pure volatility, the high beta trading revenues from their internal hedge fund. And our mission for this deep dive is to figure out how that tension led to, frankly, one of the wildest earnings reactions this quarter.
Exactly.
Yeah.
Because despite management coming out and saying the company has, and I'm quoting here, never been stronger, the market just did not buy it.
Not at all. The reaction was immediate and pretty punishing, a total reversal in sentiment.
Driven almost entirely by those headline numbers and a huge, huge adjustment to what they expect in the future.
Yeah. When those first numbers hit the wire, I genuinely think a lot of analysts probably thought there was a typo. The miss was that big.
So let's start there. Let's get into the hard financials that really caused the panic.
Okay, the big miss. If we look at the GAAP and IFRS figures, the standard accounting everyone uses, it showed trouble right at the top and the bottom.
The bottom line first. Earnings per share. The street was expecting something around 7 cents.
And DFT reported just 1 cent. That's an 86% negative surprise. I mean, when you see a miss that big, the market's first thought is that something is fundamentally broken.
And the revenue picture just hammered that home.
It really did. The consensus was sitting around $41 million.
They reported $22.5 million. A miss of almost 45%. And year over year, that's a decline of nearly 20% from Q3 of 2024.
Those are the numbers that just tanked the stock right at the open.
But this is where the story gets, a lot more complicated. Because the company's internal metrics, they told a completely different story. A narrative of resilience.
Right, which is why management felt they could say they were still strong. Despite that revenue shock, the company still pulled in $9 million in operating income.
Which, is down from $14.4 million the year before, but it's not a disaster.
Far from it. And that operational efficiency meant their net margin was still robust, almost 24%. It tells you they've got their expenses under control, even if the revenue is a wild card.
And the most important part, the core asset management business, Valour, it just kept growing like clockwork.
It's the anchor. Assets under management, or AUM, nearly hit that big $1 billion psychological mark. It closed the quarter at $989.1 million.
And they saw net inflows of, $38.8 million in Q3 alone. That proves investors are still piling into their ETPs.
That compounding base is everything.
So you have this picture of a strong compounding core business, but it's completely overshadowed by one single thing.
The guidance.
The elephant in the room. This was the single most important part of the entire conference call.
Absolutely. We saw, catastrophic revision to the 2025 full year revenue guidance. It was slashed from a huge $218.6 million.
All the way down to $116.6 million.
That's a $102 million drop. Just gone, vanished overnight.
And management spent a lot of the call trying to explain this away. They put all the blame squarely on that high beta DeFi Alpha trading arm.
They gave two major reasons, and you have to listen to the language they used very carefully here. First, they claimed these big trading opportunities they were expecting weren't lost, but simply delayed.
Delayed and deferred. That sounds a bit like corporate speak for we have a problem, doesn't it?
It can. You have to ask, what proof did they offer that these massive opportunities are still even viable?
And what was their second reason?
This one is a bit more believable. They argued that arbitrage profits were severely compressed in the back half of 2025.
Okay, so why?
Competition. Specifically from what they call digital asset treasury companies, or DATs. Basically, too many smart players all jumped into the same trades, chasing the same spread, which just squeezed the profit margins for everyone.
So the opportunity didn't just get delayed, it also got crowded.
Exactly. And the silver lining they tried to push was that the remaining $116.6 million, that's their core revenue. That's the predictable business from AUM fees and lending.
But even hitting that core number depends on a big market assumption. They admitted they're relying on a, quote, modest rally in crypto.
Specifically mentioning Bitcoin needing to hold around that $100,000 level. So yeah, even the stable business has a pretty big crypto beta asterisk next to it.
So to prepare for all this volatility, Their balance sheet shows they were getting ready. They closed a huge $100 million registered direct offering in late September.
And that capital raise was critical. They ended the quarter with a treasury totaling $165.7 million. That's cash and digital assets combined. That's their hedge.
And what's really interesting is how they started using that capital right away. They bought back over 935,000 shares for about $2.4 million.
Which is a bold move.
Hold on. If you just cut your guidance by $102 million, why are you buying back stock? Isn't that sending a mixed message?
The message they're sending is, we missed, but our stock is way too cheap compared to our cash. It's an aggressive signal of internal confidence in the long-term asset base.
We should also touch on the staking yield dynamics, because that capital raise is directly tied to it. We saw the effective yield dip a bit, from 3.6% in Q2 down to 3.1% in Q3.
And that wasn't just the market. It was partly a choice. They said it was due to infrastructure tuning and needing more operational capital for their market making.
They had to pull some assets that were earning yield to use as liquid collateral instead.
Exactly. They sacrificed a tiny bit of yield to make sure that ETPs, which drive all those reliable fees, stayed liquid and functional. A short-term trade-off.
And they're confident they can get that staking percentage back up to their 70% target now that they have all that new cash.
Right. The new cash lets them use external collateral without having to sacrifice their own staked assets.
Okay, let's pivot to strategic execution. If Valour Asset Management is the anchor, we need to talk about its success.
Valour is the bedrock, no question. A record average AUM over 900 million, and they crossed the 100 ETP milestone.
Which includes that big one, the first Bitcoin staking ETP on the London Stock Exchange. That's a huge marker of innovation.
And their vision is clearly global. They're looking way beyond Europe now. Africa, Asia, the Middle East.
And using new vehicles to do it. Funds, leveraged products, even bonds. They're just trying to find regulated ways to bring in institutional money from anywhere in the world.
Then you have the other high-margin business, Stillman Digital, their institutional trading arm in the U.S.
How's that tracking?
Strongly. $2.2 million in commissions for Q3, on pace for about $8.6 million for the full year.
What's driving that?
Two things. First, new services, like integrating into the Talos network, which just gives them access to way more institutional liquidity.
So more buyers and sellers.
Exactly. And second, they got a Bermuda license, which lets them service international clients much more efficiently.
Okay, let's circle back to the real problem child. DeFi Alpha. This is where that $102 million deferral came from. Management actually gave some specific examples.
They did. Two major multi-year locked token trades, one in SUI and one in SOL. These were complex arbitrage deals with embedded discounts that represented over $27 million in potential profit.
And here's the crucial detail that explains the guidance cut. The principal on these trades, the firm's actual cash, is 100% hedged. It's safe.
But, and this is the big but, the profit is retained in the underlying tokens.
Which means the profit itself is completely exposed to market volatility. If SUI or SOL drops, so does that profit. The guidance cut wasn't about losing money, it was about the expected profit shrinking.
Precisely. It just highlights the high-risk nature of this one part of the business.
And all of this is happening right in the middle of a huge leadership change. Co-founder Johan Wattenstrm is now the CEO and executive chairman.
It's a big handoff. The outgoing CEO, Olivier Roussy-Newton, is stepping back to a strategic advisor role to focus on his post-quantum security company, BTQ.
So the message is continuity, using that new capital to hunt for M&A, maybe find a way into the U.S. market.
Right. Which brings us to the investor context. The disconnect between management saying we're stronger than ever and the market's reaction is massive. The stock dropped over 15% on the day.
And it's still trading at a steep discount. The focus now is all on execution. They have to prove they can make money outside of a raging crypto bull market.
And it's not just a DFT problem. The stock has materially underperformed broader blockchain indices, like the BLOK ETF, over the last year.
So it's not just the crypto winter. There's a company-specific confidence issue here. What are the near-term catalysts people should be watching for? What could change this story?
First, in Q4, look for them to officially recognize that $3.2 million SOL arbitrage profit. That's a proof point.
Yeah, what else?
Geographic expansion. Management teased a new big market they're entering but can't name it yet. That could be a huge unlock.
And what about new products?
Look for traction on new business lines. They're repositioning reflexivity research to offer institutional digital asset scoring. That's a steady revenue stream. And watch for these new hybridized products and talked about, things like equities or debt aimed at global institutions.
So diversifying away from that volatile trading arm.
That's the goal.
All right, we have covered the volatility, the capital, the strategy. Before we wrap, it's time for our segment. This is not financial advice. This is purely a theoretical exercise for entertainment and educational purposes. Always consult a professional.
That said, the context is pretty stark. The stock is down over 50% year over year, and with that big Q3 drop, it's trading at a heavy discount to its AUM base and that huge $165 million treasury.
And the whole conflict is about the timing of that deferred $102 million. The market thinks it's gone forever. Management says it's just delayed.
Which brings us to our outrageous but plausible trade idea, the staggered arbitrage recovery spread.
Okay, that sounds complicated. Break it down simply.
It's a two-part bet. Part one is a pure bet on the balance sheet. You buy a big block of DEFT equity, hopefully near that $1 low we saw on earnings day.
So you're buying $1 worth of stock that's backed by a ton of cash and growing AUM.
Exactly. Part two is the hedge. You simultaneously sell deep out-of-the-money put options that expire in Q1 of 2026.
Which means you're collecting cash now and you're betting the stock won't fall much further in the next 6 months.
That's the structure. You're betting that the new CEO, Wattenstrm, can execute on at least some of that deferred revenue and that any progress will force the stock's multiple much higher.
So the outrageous part is betting completely against the negative sentiment, based on the belief that it was a timing issue, not a failed strategy.
It's a high-conviction bet on a management reset and pure operational execution.
It is. So to quickly recap, the core tension. DeFi Technologies has strong compounding assets and a ton of cash, but its top line got completely torpedoed by its unpredictable arbitrage business.
And that leads to our final provocative thought for you to chew on. Given the CEO transition, with a co-founder taking over and the old CEO moving on to a totally different venture, how much of this huge guidance cut was really the market?
And how much was just kitchen sinking the numbers?
Exactly. Did they just lower the bar as far as possible to give the new leader an easy target to beat for 2026?
A very compelling question. Thanks for diving deep with us today. Go explore the ideas of timing risk and arbitrage spread compression. We'll catch you on the next deep dive.